welcome all of you to this special grilling session of Raamdeo Agrawal by a person of equal and more merit, Ramesh Damani, and I'll play the pleasant onlooker. I also welcome our viewers of CNBC TV18 at this juncture. Well, Raamdeo, let me start with your allocation chart, if I can bring it up. Your power of allocation, after all, the significance of the 21st wealth creation study is that up till 20 studies, MOSL was concentrating on what to buy, but now they're trying to arrive at a formula on how much to buy. You had those three portfolios with Bajaj Finance and Eicher Motors having an exaggerated presence in one, an equal presence in the second, and lesser presence in the third, and so you got one market beating 18%, one as much as the market 5%, and another one minus 8.5%. Now, my question to you is, how much is your formula helping you allocate? I mean, on hindsight, you know that you should have put more on Bajaj and Eicher. But today, if you were to sit and I asked you to make a similar portfolio, which one will you give 10%? Say, you all know that digitization is the wave of the future. Will you give 10% to Orion Pro? Will you give 10% to Nucleus? Will you give it to HK Mile? Will you give it to Infosys? Will you give it to TCS? On hindsight, you know that there should be exaggerated betting. But do you know when you are betting? I thought you were clever in not giving Hero Moto more than 3% in 1995. After all, you got your price from the dividend itself in a few years. Suppose you had bit exaggerated and Hero Moto turned out to be central bank. What would you have done?
So this goes on. In investing, there is no guide. That's why you don't bet 100%. The very purpose that you don't bet 2%. What I'm saying is that you bet 5%, 6%, 7%. Become better once you realize that you have an edge in understanding and the company is going to do well. I mean, I know for sure, I'm telling you that those situations I talked about, all three of them, I distinctly remember when I came to my room and started buying. I knew we are sitting onto a winner. And it's not that very day you have to know. Even after 3 months, 6 months, once you start winning and things start opening out to be better, say 500 will become 700. I mean, this is not the end of the journey. You can double your bet. Say you started with 3%, you can buy another 3%, but very quickly you take it to 8-9%. Typically what happens is, I'll tell you Eicher, I came to know about it at 6%. By the time we researched, it was 1800, and first stock I bought at 2100. And barely, I wanted to buy 50,000 shares on that very day. I got 26,000 shares. After that, the stock shot up to 27, 28. I never completed the buying. So what you allocated in your mind, that also you couldn't complete on that very day because the price moved by 100, 200 rupees. So this is an admission of what actually has happened. But if that day, if I had decided out of my 100 crores, I am going to buy at least 5 crores worth of Eicher, or 10% of that, say 10 crores worth of Eicher, the story would have been different. I'm not talking about betting 30, 40, 50%. That is not part of the focus strategy. That is part of the concentrated strategy.
Basically, it is courage, isn't it? Courage of your conviction.
Yeah, courage of conviction. So courage and conviction both are important. You have to build the conviction. Say you have done 2 hours work 2 hours more, and work on the mathematics of it. What it means, because these ideas you are not going to get every day. You get once in 1 month, 1 year, 2 years, you get the ideas. When you get the ideas, do a percentage betting rather than absolute number of shares. A lot of people, they practice very differently. They'll buy, I bought 1 lakh shares. But it's 20 rupees share. In your 20-30 crores portfolio, how does it make a difference? So you have to think in terms of percentage of the portfolio first and then increase the percentage to the acceptable level. I'm not talking about something where you can be completely killed. Like if you lose, then you lose your shirt. Like I'll tell you, in financial technologies, we bought 5%. We actually bought 5%. That became 0 in 6 months. Yes, but that very year, we bought Eicher 5%. That became 4 times. So the diversification and your conviction, that will take care of your portfolio.
Fair enough. I was debating in my mind whether to give the example of central bank or financial technologies. Since you said financial technology is fine by.
I picked a better one.
Yes, absolutely. Well, Ramesh, before I allow you to do the grilling, is it really as easy to bet big, to recognize the payoff and bet big? Or will you always be wiser only on hindsight? I mean, McDowell's. You could have bought 25%, but you chose to buy perhaps 2.5%.
I wish I'd bought 2.5. I didn't even buy that much. It's actually the hardest thing. As I look back at my career, Lata, I've been blessed. I've been able to pick some great stocks, and they've gone on to be 10 baggers, 20 baggers, even 100 baggers, many of them out there. But I'm not a billionaire like Raamdeo yet, you know. And the reason is that I haven't been able to bet the size that you should bet, because at that journey there's always self-doubt, there's a lack of confidence, there's a lack of conviction in your own ideas. And for an investor to mature and become, Raymond talks about the complete man, I'm talking about the complete investor. I think there's a maturation process. I don't think from the get-go you could be foolhardy and do it, but a mature investor requires to go through various bull market cycles before he knows in his heart what's right and what he can bet. And even after 30 years, perhaps I'm just reaching that stage. So it's an extremely difficult journey, extremely difficult.
Yes, I guess 21 wealth creation studies somewhat get you there, your guess.
Raamdeo, you know, someone told me that concentration is not for cardiac patients, okay? You have a lot of volatility associated with that.
Yeah.
So would you say that concentration is just for really professional investors, and amateurs should not try their hand at it?
Clearly, I mean, concerning strategy, we are talking about single-digit portfolio size. I mean, 7, 8, 9 at best. So that for that one, it has to, the character of money has to be private money, or money which is available, a permanent capital you can call it.
No, you know? Even for private investors, not mutual, private investors, would you recommend that regular guy goes in for a concentrated investment strategy?
I would recommend. I mean, if I was blessed with private capital in a situation where I'm managing my own money, at this starting from here, I would do concentrated, and I would do, I mean, low single-digit strategy after this study for sure, because downside is limited, upside is massive. You know, I mean, it can make a huge difference, but you need to bring that edge. You need to do a lot of work before you arrive at that situation that yes, this is a situation where you have a huge upside, very limited downside. I'm telling you, in Aisha, I went to my dealing room and I told the guys, the upside is 10 times and downside in 5 years is doubler. That was the thesis. Upside was, I said 6,000 crores market cap, it is likely to be a 60,000 to a lakh crore company, and downside is minimum doubler. Because we thought downside is the Royal Enfield and truck is the upside. It turned out to be the other way. Yeah.
Truthful.
Yeah.
Yeah. So let me pursue this point one of the way. You know, Charlie Munger said, why do you want to bet on your 20th best idea? Bet on your best idea and bet very seldom and keep looking for mispriced bets, right?
Yeah.
So we come back to the point that we started with, the lookout for the mispriced bet. Give me an example of how that happens, other than ones you talked about. What should an investor look for to, you know, find the mispriced bet? Is it within a circle of competence? Is it during special situations? Is it, as Warren Buffett found, when the American Express stock collapsed? Is it early in the bull market? When do you find these mispriced bets?
So I can talk from my experience in Indian market. You know, I mean, these are 3-4 ideas which I actually practiced, and it was clearly mispriced, and mispriced when I bought it. I mean, not looking back. I could see that at that point of time, and if not then, maybe a little later, say Infosys. It was a very clear opportunity in 97, 96. I mean, you might have started maybe 94. I mean, till you bought it, till 97, anybody bought Infosys, he made it 100 times in the next 3 years. Okay, so the opportunities come. And say like HDFC Bank. HDFC Bank, when it got listed in 96, I mean, I had a clear understanding of the value migration that this, I mean, one of these private sector banks are going to make very big out of the banking opportunity and more probably decline in the PSU banks in 96 itself. When the stock got listed, 200 crores was the equity and 40 rupees the price. In 5 minutes you could buy 1 million shares.
Right.
That was the liquidity. And I did buy, but there was some other story and I got out at 52 rupees and the price never came. So the issue is that my conviction, see, you were sitting in a room and you had these books read and you understood the concept, but you actually not working towards building the edge. We never visited the management at that point of time, 96. I didn't have access to, say, Aditya Puri, or there was no formal research setup, and you couldn't go to meet the agency management.
CNBC TV18.
Yes, that was also not there. Okay. So we didn't create edge, and I could see big opportunity that it will double. See, typically we start with doubler or tripler in 3-4 years. That's the basic expectation. Who knows it is going to go to 100 times? Even the management don't know that it is going to go 100 times. So, so clearly that opportunity was there. There was a massive tailwind. I think the place to start is the tailwind. Massive tailwind and limited competition. I mean,
let me take it from there. Before I come to massive tailwind and limited competition, if you were to use the same HDFC analogy now, your theory was that it was very clear that the private sector banks will take over the terrain of the public sector banks. Today, will you say that NBFCs will take over a large part of the private sector terrain also, and certainly a large part of the public sector terrain? Therefore, that is the tailwind?
yes, I mean, there are certain, again, niches, because riches are in niches. I mean, small niches, say, housing finance companies. That's a, I mean, PM Saab says that by 2022, the whole, I mean, he wants to have housing for all. Even if this country is able to build houses for all by 2042, I mean, you have a massive tailwind on the mortgages.
Okay, so having identified the tailwind,
Yeah.
how do you identify the winner in the pack? Is it the market leader HDFC, or is it the one who is not yet
there are-
recognized by the market?
So there are there are big, I mean, of course, if you want to make 20-25%, at 18-20%, that leader is good enough. But it's large, and on a large base to compound 25-30% is tough. It's humanly impossible to, for 10 years, again 10 times. I mean, it may happen, but it is tough. But you can find newer emerging housing finance companies which are well managed and who are actually I mean, we did this in group finance just 4-5 years back. We bought it for 200-300 crores and it went to 10,000 crores. It is the most expensive mortgage company. It is selling still at 12-13 price.
I aspire to find another group. If you get my drift.
Yeah.
Well, tailwind in a sector that will definitely have tailwind and limited competition, airlines. But how do you identify? I mean, you put your bet on Indigo, that's in the public domain. But how do you identify within this space available that SpiceJet won't do better than Indigo? Is there a formula to get, having identified the sector?
That is simple, but you may raise a very interesting point, because Raamdeo and I have had this running argument about airlines, and for the record I'll state that Southwest Airlines in America has outperformed Berkshire Hathaway over a 40-year period. That's a historical fact out there. But, so Raamdeo and I, he's come full circle. He agrees with me now because he's smart, So. I want to come back to the timing part, Raamdeo, because I find that in my life, when I look back, the best opportunities came when the bear market was ending and a bull market was beginning. Because stocks are so cheap by almost any valuation we take there, that if you want a concentrated strategy, you better go in at that time. Because if you wait as the bull market matures, either you'll deteriorate in quality or pay a very high price for that, and as a result the superior returns don't come. So is that an extraordinary focus during that twilight zone when the bear market is ending and a bull market is beginning? Is that something you focus on?
I would not, I mean, that's of course a godsend opportunity. You get a business opportunity and added by a cheap price, because I mean, we saw that fastest wealth creating companies are less than 1,000 crores. So the purchase price and size of the company is extremely important to build a high compounding for long periods of time.
Correct. But you get them at the beginning of a bull market.
Yeah, so at the beginning of the bull market, even fairly large companies are available throwaway prices. Like in 2003, I mean, that was, I think, worst possible time in recent history of Indian market. At that time, index itself was trading at 11-12 times. Reliance was available at 7p multiple. A little bit of fight was going on and all, but it was available at 7p multiple. Price to book was 1.2, 1.3. So at that point of time, even very large companies can be a multi-bagger. You know, so you can't take away the power of buying extremely cheap at a market level, because relatively all the stocks will be available at those kind of valuations. But I don't think the concentrated strategy has much to do with market timing. It is about the stock timing. You see, after 2003, it's not that market opportunities didn't come. Look at, say, Eicher, just 4 years back, or Bajaj Finance, just 5 years back. I mean, these opportunities come even in best of the markets. The new companies are born.
At the beginning of the 2013 bull market, right?
Yeah, you can say that, but it's not because of the bull market. It would have happened otherwise. Like, say, in two-wheeler industry, there is nothing much has happened last 5 years. But this stock has gone like almost from 2,000-3,000 crores to 60,000 crores. Okay. So, opportunity has to be seen. Of course, low price is very important to increase the odds. Odds will be much better if the market is also depressed, because that's a very important. One is the company's earnings growth. Ultimately, it's about two things: buying cheap and buying lot of earnings growth. So, if you get very high quality earnings, high earnings growth at low price, and low price aided by the low market situation, I think it will definitely help you. At that point of time, you get many more opportunities, but I would think that has a limited role to play in finding multi-baggers.
Okay, but you know, the reason why I interrupted is, Raamdeo actually goes entirely, strongly against what you're saying. Look at the first key takeaway. Think stocks, forget markets. But what Ramesh is saying is, think stocks, but also think markets.
See, when you're buying a stock, you have to pay a price, because there is only thing is the price out there. And I would like to have lowest possible price, and whatever helps to get the price low, if the market, because market is, stock price low because market is depressed, it's very good for me. But so that cannot be the everything.
Therefore, the twilight zone is the time to think more or bet big. That's his proposition.
Raamdeo is actually that focused on stocks, so I get his point. But experience teaches us that there's a tide, there's a bull market tide. All stocks go up when the market is bullish. A great company producing great results in a bear market will go down. So, you know, my observation has been that only when a bull market has started, or maybe a few months before it's actually started, will these stocks start to show resilience and go up. I find it most productive to buy it in that period, because anytime I go back and look at my career, the 92 stocks, the 98 tech boom, the 2003 boom, the stocks that I bought during those times are 50x, 100x, and the stocks I bought in the middle of the bull market will give you decent returns, or sometimes even give you losses. But those are all because you're so scared at that time. You're so scared that it's hitting a nail and nailing it at that time. You're scared to buy, and that gives you the great return. That's my experience.
Yeah, I mean, clearly the low markets do help in enhancing the returns. We have seen study after study, if you buy depressed, you are going to make a lot more money. First, the beta itself will be, or the market will be very high for that limited period. So, the superiority of the company is just, I think, the top up on that, you know. But I'm just saying that earnings growth and P multiple, I mean, there are two engines. You are talking about the P multiple, but earnings growth is the main driver of wealth creation.
Of course.
Well, yeah. I wanted to dwell on the mistakes. Yeah. Okay, overstaying with the losers, as you said.
Pardon?
Overstaying with the losers is one of the cardinal errors. But it's a thin line between overstaying with a loser and courage of conviction. Probably you are staying with the loser because your conviction is telling you that it is going to turn around. Can you always distinguish and be sure that this is the loser and you are overstaying? Is it always that clear? If it was that clear, you would have anyway got out.
No, it doesn't happen. The moment I have seen, I mean, of course, I am emotionless in terms of selling the stock, but if somebody has bought at 100 and the stock quickly goes to 80, he is married to the stock. People are not that easy to book losses, and that too very quickly. After a few years, if he gets some better opportunity and lot of pressure from some friend or something, then only he will book losses. A lot of people, they just stick, in fact the retail investors, they stick to their purchase price, and that's why whenever the stock price comes back to the purchase price, they sell the stock, and that's why the stocks find a lot of sellers at some kind of level, you know.
But cannot a reasoning that I am overstaying with a loser actually turn out to be a wrong decision, because your original conviction in that stock was probably right?
Yeah, I think there are two parts to that. Suppose you're losing money. That's your cost price, losing money. And that's simply said. You need to get out. He's completely right. What happens when in a bull market, for example, Titan went from 40 to 1400, corrected all the way down to 800? Were you sticking with the loser, or did you have the courage to see it go back from 800 to 4000?
Exactly.
That's the question.
Yeah, and Lata, I think in losers, I'm not talking so much about the price losing. I'm talking about the value part of it. If see, you bought something thinking that this company is going to grow, say I bought Hero Honda. By chance, I thought it is earning 25% ROA, growing at 25%, available at 15-17 P multiple. That's my thesis. Now, after 3 years, the company has major, say, labor problem, you know, and the factory doesn't open for 6 months, 8 months, whatever. And the back of the management is broken, and the competition is taken away the market share. You know what happened with Maggie or something. So if by chance those kind of things happen, the business logic for which you had bought, that itself is completely gone, and you still overstaying with the stock. You know, it is not playing out as per your theory. Price is one part of it. You might have paid a little more, but actually the earnings story is on. So I would stay on.
Well, ladies and gentlemen, I think they've had an extremely enriching conversation with two titans of markets and of investing. Thank you very much for enriching us and disagreeing with each other, which makes it all the more interesting.
Thank you, Lata.
Thank you.